Meantime, the debate in Congress over the $2 trillion coronavirus relief package is over. President Trump signed it into law on Friday. Joining us right now to talk, though, about how that aid will impact the U.S. banking system and the rest of the economy. Bob Diamond, founding partner and CEO of Atlas Merchant Capital. He's also former CEO of Barclays, and he's lived through a crisis and knows a thing or two about one. Bob, thanks for joining us this morning.
Morning, Andrew. Glad to be here.
Help us try to understand how you're seeing this crisis, what the timeline looks like for you, and how you think it's going to impact the economy before we even start talking about the banks and the rest of it.
You know, about 10 days ago when I was on CNBC, we talked about, we felt that the near-term impact in the economy generally we're underestimating. No one's talking about that anymore. We know there's going to be a really, really serious impact near term on the economy for all the reasons. But I think what struck me last week, Andrew, is this bazooka is going to be much more effective than I had anticipated over the previous couple of weeks. If you look at monetary policy, particularly monetary policy now relative to what happened in 2008, it's coming much faster. It's coming in bigger size. If you notice on most of these programs, we haven't even had limits put on them. And it's coming in a much deeper and broader sense. So whether it's municipals or investment grade debt or corporate commercial paper, this bazooka of monetary policy in terms of how quickly it's come, how broad it is, and how large it is incredibly impressive and is going to have a big impact on liquidity for sure.
In terms of, though, the economic recovery, do you look at this as a V situation, a U situation, an L situation? What's your time horizon for how this all works itself out one way or the other?
Well, I think the time horizon is very much a medical question, and I don't have anything to add to the experts that we've been listening to. But I do think there's no question that we will see an economic recovery, particularly given the fiscal stimulus, which we can talk more about. But I think the fiscal package, both in terms of speed and in terms of size and depth, is very, very impressive. But I think it's unlikely that this is going to be just a V-shaped recovery. I think we're going to see a very uneven recovery depending on which sectors of the economy that we're talking about. So, personally, I don't see businesses, I don't see non-businesses really reacting particularly quickly in terms of travel. I think people will be a bit hesitant to jump on crowded planes, go to crowded hotels and resorts for a while. I think it will be uneven. I think it will recover, but it will likely be uneven. I think the same in business. Certainly at Atlas Merchant Capital, I think we're all very pleasantly surprised at how effective we've been working remotely and how effective many of our portfolio companies have been working remotely. And so some of the benefits of this will definitely translate into working behaviors going forward. So while I'm pretty positive on an economic recovery, don't know the timing. I do think the fiscal stimulus package has been quick, has been very, very large, and has been very broad. But I think we're likely to see more of an uneven recovery.
Bob, what do you think of the valuations of the banks today?
So I think the big banks, and I assume, Andrew, you're referring to the listed big banks, the J.P. Morgans, Goldman Sachs.
Yep.
I think at one point they were down 35 to 40%. I think now they're down 20 to 25%, something like that. And I think that reflects earnings potential given a lot of the changes that are going on. But we have to keep in mind that this is the banking sector, particularly in the U.S., has never been safer and sounder, better capitalized than it is today. I do think one has to be careful about translating that outside of the U.S. As you know, a lot of the things that were done in 2008, 2009, and 2010 to help the banking industry recover here in the U.S. around Chairman Bernanke's monetary policy, but more importantly, the TARP program, were not replicated in Europe, at least not for a number of years. I think it was 2011 or 2012 before Mario Draghi really came to grips with the need to have a bazooka in terms of monetary policy. And the bank recovery or capital markets recovery in Europe has been nothing like it has been in the U.S. So I think it'll be very uneven, but I think it'll be very positive in the U.S. for the big banks.
And then the other question was, do you have any anxiety or worry about the CMBS market or other markets where you think there might be risk in the market today, even with the liquidity that the Fed has put in place?
We've definitely had to manage more closely certain clients in the short end of the market. I think the volatility of the spreads between mortgages and treasuries, as Joe was pointing out in the show earlier today, is real. I think it's beginning to get resolved, but I think these are issues of spreads between different classes of securities as opposed to an overall liquidity issue. I think the attention that the Fed is paying to the short end of the market is absolutely appropriate, and they're all in.